Our next speaker will be Dr. Sennholz, President of the Foundation for Economic Education, to speak about bull markets and bubble phenomena.
Thank you. I know we're late, but you have a full hour. We just ran behind 1 hour.
Okay, thank you very much. Thank you very much. You're 50 minutes behind schedule, so if I limit myself to 10 minutes in my presentation, we will be back on schedule. But having come this morning from Pennsylvania and having flown 1,500 miles in order to get here, I think I'll try to make it a little longer. I think it's very befitting for you to invite an economist here, of an association of doctors for disaster preparedness, to invite an economist to talk about a forthcoming economic disaster. And I intend to talk about the stock market and what's going to happen to the American economy. Surely I could continue to talk about war and nuclear war. I think the possibilities of such a war, nuclear war, are rather remote. But I think I would be qualified to talk about war because I've seen a lot of it. During World War II, I used to be a German fighter pilot, and I lived to talk about it. So I could continue to talk about war and survival. But I'm not here to talk about nuclear war, any kind of war, but just to talk about an economic disaster which may befall us at any time. And this is the stock market. In the past, I used to talk about a bubble economy. For the last 2 years, I talked about a bubble economy and about the inevitable bursting of this bubble in the coming days. But today, for the first time, I would like to go a step further, and I call it a mania. The mania of the stock market, which is going to come to a disastrous end. Of course, most American economists don't talk like this. Everything seems to be fine. The American economy is the envy of the world. The GDP, that means the gross national product, is said to rise, to increase at a rate of some 5.6% in the last quarter. Last year it was 2%. The unemployment rate is the envy of the world, only 4.9%. Last year it was 5.5%. You know what it is in Germany? It's about 12%. In France, about 13%. In Spain, about 20%. These are the conditions in Europe. The leading indicators, economic indicators which guide economists, are at 103.6%, and last year at 101.7%. The inflation rate is about 2.2% and about the same as last year. The sales in the last month, in February, were $746 billion when compared with $697 of last year in February. I just would like to share a few statistics with you, talking like an economist. And the orders of purchasing agents orders index right now is at 54.2% when compared with 50.1% last year. And yet, when you look at the stock market, just this last week, the stock market, the Dow Jones Industrial Average, has closed at record 5 consecutive days and charged through 7,500 on the Dow, 7,600 and 7,700 just this last week. The bull market has hurled all the obstacles I ever have seen in my 47 years in the American stock market. What is all this? As a matter of fact, there's a tremendous wealth effect of this, which is visible everywhere. The people who have their money in the stock market are gaining, are profiting every day, which has a tremendous wealth effect. They're enjoying, the American people are enjoying a vast increase in their personal wealth, people in the stock market. And as a result of this wealth effect of the stock market, there's a tremendous boom in consumer spending by wealthy households, by you. Tremendous consumer conspicuous consumption as a result of this wealth effect of the stock market. The consumer credit is at an all-time high, $1.2 trillion right now, when compared with $1.1 trillion last year. And it doubled. Consumer credit has doubled since 1985. These are the economic conditions. But throughout the history of the economy of the in the Western world, the capitalistic system during the last 200 years, there always has been the trade cycle, the business cycle, the ups and downs in the economy. You know, the boom followed by the bust and the recession, the depression. This has been an invariable phenomenon. Not because it's a feature of the free economy, but because it's a feature of politics in money, in the management of the stock of money. Today we have the central bank, the Federal Reserve System, which has existed since 1914, managing the national stock of money. Most of the time promoting and injecting funds. All eyes today are on the Fed. Just listen to the news, to the financial news every day. They talk about the Fed and Alan Greenspan, what he has done or what he's going to do tomorrow. He's going to meet somewhere sometime next week, and they'll all be talking about it, and all eyes are glued on the Fed. That's political management of money. That's not the free market. That's not the free economy. The free economy would be no central bank, no management, political management of money. But we do have the system ever since 1914, getting more powerful, omnipotent all the time. And throughout the history of the last 200 years, we had the ups and downs, the recessions. The last recession we had, as you know, was in 1973 to 1975. And at that time, you may remember, we had an unemployment rate of some 11%. The economy declines, output declines. And a recession, actually, from our point of view, is something very beneficial. It's the boom time that does the harm. When there's easy money is being injected in the economy, interest rates are very low. And as a result of this injection, the political injection of new money, business at low and artificially low interest rates makes many mistakes. You have malinvestments, factories that are built, and houses and hotels being built that have no economic justification, except the low interest rates. The low interest rates induce businessmen to do things which they otherwise would not do. And that's maladjustment, malinvestment. Then you have a feverish economic boom. And consequently, sooner or later, this fever breaks, and then you have the recession, the decline, the readjustment, the inevitable readjustment to this preceding boom. It's the healing time. The recession is the healing time when business has to cut back, has to economize, has to correct mistakes, write off the mistakes, and so on. And finally, then the economy picks up again. This is the normal order of things. So sooner or later, there has to be a recession. There always have been, and today, we had this since 1982 for the last 15 years. There was a beginning of a recession, surely a couple of times, apparently, but then it picked up again. The last real recession last time in 1982. 81, 82, during the first 2 years of the Reagan years. A recession. Well, I think this time is much worse. Once in a great while, you don't just have a recession, you have a mania, which is followed by great economic difficulties. What is the nature of a mania? An investment. We are seeing an investment mania. It's a madness that takes hold of the population. And we may be witnessing the greatest of all times in American history right now. It's very similar. I would like to mention two others. Very similar to this madness of the 1920s, which led to 1929, to the crash and the deep depression, the Great Depression thereafter. And I also would like to mention the Japanese depression of recent years. The Japanese, it's very similar. We have a situation very similar to the Japanese mania of 1974 to 1989, when the Japanese were all over the world buying anything inside, when the real estate prices went sky high. I think a square mile of real estate in Tokyo was worth as much as all the real estate in California at that time. When the stock market, the Japanese stock market, the Nikkei, went from 2,500 on the Nikkei to 39,000 in 1989. These are the two recent examples, again for the same reason, the same phenomenon. I'm contending that we are witnessing one right now here in the United States. What are the features of a mania? At first, you have a powerful, persistent rise in valuations, powerful, persistent rise with fewer and fewer adjustments. And I'm pointing back to going back to 1982. Here it began in 1982 after the last Reagan recession of 81-82. You must remember 1982 in August. Or let me put it this way, at first already there was a stabilization of monetary policy already under Jimmy Carter in 1980, and finally there was the election, then Reagan was elected, and Reagan continued a stable monetary policy until August of 1982. But what happened in 1982, by that time the American recession was spreading to other parts of the world. In August of 1982, Mexico defaulted in payment, in interest payment. American banks had lent Mexico, I think, some $80 billion in bank loans, and finally the Mexican government defaulted. And because and then immediately Brazil followed suit and all others. And immediately there was a possibility that if Mexico, a big debtor, would default, then the big banks, our banks, creditor banks, would default as well. Because some had lent as much as 200% of their capital and more to Mexico, which was defaulting. Consequently, the US government immediately rushed, I think it was some $25 billion in emergency credits to the government of Mexico, and then the International Monetary Fund rushed another $8 billion to Mexico in order to make payments, and the crisis passed. And from that moment on, then the American monetary authorities then eased credit, made money available, lowered interest rates, and began to expand again. And this present boom and stock market boom had its beginning then in 1982. And at first it began very slowly with fewer and fewer readjustments, and until finally it began to accelerate. Another feature of a mania is the broad participation by the public. You know, today 43% of the American households hold stocks directly or indirectly. And I would assume that here 100% of you are owning stocks directly or indirectly, through your pension funds, insurance funds, and what have you. From 43%, that's vast popular participation, which is a basic feature of a mania, people getting involved. Nowadays there are 2,700 mutual funds, 100 springing up, it seems, every month. Mutual funds are investment companies collecting money. They receive between 15 to 20 billion dollars of new money every month to invest, which they have to invest in the market. That's the mania. And this money does not come from savings. It comes mostly taken out of the savings banks. We are reducing our liquidity and putting it in the stock market. That's a feature of a mania. The broad participation by the public. And another feature is a huge overvaluation. Huge overvaluation of of all the shares, the facilities. And in fact, the American economy since 1982 has about doubled in monetary value. If you eliminate the inflation factor there, perhaps the American economy has grown by some 50%, but the stock market has risen tenfold, from a Dow Jones average of 800 to almost 8,000. The economy in real terms has risen 50% since 1982, the stock market 1,000%. That's a vast overvaluation. It has been calculated that if just the return right now on stock investments of the Standard & Poor's 500, I think is 1.35%. Just in order to get back to a 3% return, the market would have to drop by some 3,000 points, from nearly 8,000 to 5,000, below 5,000, just to get back to a 3% return. Bonds pay nowadays, government bonds pay nearly 7%. And now the last few days they dropped to 6.76%, let's say around 7%. But General Motors bonds, General Motors Acceptance Corporation bonds are still selling, yielding 8%. The stock market 1.3% and rising, the yields falling. That's a mania. And moreover, this is another feature in the present mania, and this is the official sanctioning. The Federal Reserve is sanctioning it. Surely once in a while Alan Greenspan is saying, mumbling something about irrational evaluation or expectations, but nevertheless, when the market broke in 1987, immediately the Fed rushed in and bought everything in size and tried to stabilize the situation. It was for the first time too that the Fed, the Federal Reserve, our central bank, rushed in order to prevent the decline from deepening, from getting worse. So you have an official sanctioning of it all, of this mania. And as a result of this, and I touched on this already, you have a tremendous, vast increase of the paper wealth. For the last 5 years, I lived in New York, in the suburbs of the Westchester County of New York. And everywhere I looked, $1 million homes were rising fast. Building everywhere, $1 million homes being built everywhere. Not the poor people, there is no additional wealth. There's only this paper wealth of the people in the stock market. Young brokers and financiers in the stock market are enjoying a tremendous paper wealth. Remember, the national economy has grown, let's say, since 1982 at a 3% rate, and that's saying a lot. And the stock market has risen 1,000% and rising, beating, reaching new highs every day. Which I mentioned has led to a tremendous consumer spending. Then there's another factor which I would like to mention here, and this is our dependence on foreign money. The foreigners are in, they have something to do with that here. There is what we call the yen carry trade. The yen, the Japanese currency. You know, the Japanese, as a result of their mania, which was 15 years, now from 1982 to right now is also 15 years of a boom market developing into a mania. The Japanese, as a result of the deep recession and depression they have been in since 1990, consequently the Central Bank of Japan has lowered its interest rates to ridiculous levels in order to stimulate, induce new activity. The Japanese interest rates right now, discount rates, are 1/2 of 1%. Consumer, by the way, European rates, Swiss rates, discount rate 1.5%, German rate 2.5%. Our rates are 5%, discount rate is 5%. I'm mentioning this to illustrate a very massive force of speculation there. All in the Caribbean, all around us, there is American institutions that borrow Japanese funds at 1/2 or 1% and turn around, convert to the dollar, and buy American bonds, US Treasury bonds at nearly 7%. It's a vast activity there, speculative activity with foreign money. Primarily Japanese and Swiss money. They're speculators, institutions, index funds all over in the Caribbean, everywhere, borrowing Japanese money at 1/2% and then turning around and buying dollars, which props up the American dollar. The American dollar then is kept high as a result of these purchases, and then invest their money into American bond market, keeping bond prices high, interest rates low, and you have a tremendous activity, speculative activity. It's 0.5% interest in Japan and 5% in the United States. That's the yen carry trade. Of course, then our balance of payments deficits, we import now about $1.1 trillion of merchandise in a year, and to export about 900 billion, so there is a deficit. With the deficit we pay, and then with the money, our money goes out. We export our money and bring in the merchandise, which has two beneficial effects for us. Now, exporting our money we send our cash, our credit out to Asia, and we get back foreign goods, which keep our goods prices down. We have very, very low price inflation, goods price inflation, because all these foreign goods are coming. We ship our money out, and then the prices of goods, foreign goods, are coming in vast quantities. A stream of foreign goods is keeping our prices down. Now, what happens? What's going to happen to the end? What's the signal of the end of all this? It will come to an end, with ominous consequences to come. What will be the symptoms or the beginning? Well, a mania, we don't know how far it will run. We don't know, no one knows. We only can watch it. There's no regularity or no rhyme or reason. You don't know when it will come to an end. But we do know the longest mania in Japan took 15 years until the bubble burst in the last few weeks of 1989 in Japan. Ours now is, the life for ours is some 15 years. But this does not mean that it will end right here. It can run, who knows, few more months, few more years. Who knows? No one knows. However, perhaps there's these things to be considered. Well, normally when a recession is coming and a bear market sets in, normally there's a distribution taking place, distribution of ownership taking place. Distribution means that that well-informed people in the market begin to sell. And the ownership moves into weaker and weaker hands. That's distribution. But in the case at the end of a mania, you don't have this. This distribution. There's no warning signal of distribution. There is massive participation. Everyone denies that it will happen. That's why it's possible. If people would be afraid of a mania and say, yes, there's a possibility, it could not happen. But the very fact that everyone denies it, that this is a mania, refusing to see it, that makes it possible. However, let me tell you, in 1929, what happened in 1929. There was one phenomenon which is very similar to now, and this is that the lower priced and lower capitalized stock lagged badly behind the blue chips in 1929. Therefore, in 1929, the beginning of 1929, there were complaints that most people in the stock market with the lower priced securities didn't actually participate. They were complaining that their stock had not risen. And I think the situation today is very similar. If you look at the different indexes, the indices, the very popular one, the Dow is up, every Dow Jones Industrial up every day, and up some 35% so far this year, up every week it seems. The Standard & Poor's 500, the leading 500s leading the way, up almost 35% this year so far. But when you look at the low-priced securities today, which are measured by the Russell 2000 index, measuring 2,000 securities, they're only up 2%. We have a very similar situation today. That's why many people today, I mentioned earlier, there are 2,700 mutual funds. And very, very popular. But almost 2,600 have fallen behind the Standard & Poor's 500. There are only about 130, I think 134 index funds that have kept up with the Standard & Poor's 500. Only the leaders are leading the way. The lower priced securities are far behind. Therefore, most investors, and I assume it's also you, most investors in mutuals are complaining that their own mutual does not keep up with the index, with the Standard & Poor's 500. It's only 130 index funds. It means funds investing in those securities that are mentioned, that are listed in the index. The Standard & Poor's 500 or 100, the index, or the 30 industrials listed in the in the Dow Jones Industrial, listing 30 industrials. They are leading the way. They are going through the roof. Most others, the smaller priced, lower priced securities are not participating. They are very little, just like 1929. And another feature of 1929 to watch out is finally there was a deceleration of the advance in its final year. In other words, the advance was slowing down, appearing to be exhausted. Then the crash finally occurred. When we look at this feature of 1929, I don't see it. We are still accelerating, it seems. There's no deceleration, no slowdown in this madness. Therefore, who knows, our market may still go much higher before the mania will come to an end. Well, I'm fully convinced that this is going to happen. What can you do about it? I think recently Sir Templeton, which is a big name in American finance, a boy from Kansas who made billion-dollar fortunes in creating the Templeton funds, you undoubtedly know. He was asked, well, what can we do? And his reply, his reply was, well, this is the time to be in the bond market, not in the stock market. Get out of the stock market in the bond market. The bond market pays 7% almost US government bonds. I'm not recommending US government bonds because you're financing conspicuous spending, wasteful spending by government. But General Motors, I think General Motors is here to stay, still paying 8% right now. Now that's, and in case, let's say interest rates later in a crash, interest rates may come down. No, then the bonds would do very well. As interest rates, bond rates come down, the prices of bonds would rise. That's the advice of Templeton. This is a time to be in the bond market, not in the stock market, not in this mania. There's one possibility. Another possibility is also to take the money back where it came from in the first place, from the banks. The savings accounts and investment accounts in the banks. That's where most of the, I mentioned earlier, between $15 to $20 billion every month is sent to the mutuals. The mutuals are collecting vast amounts every month, not from earnings and not from savings, but from financial institutions, auto banks, commercial banks, savings and loan associations. In order to survive this mania, get back, put the money back where it came from in the first place. Back in the banks. And above all, also avoid this massive consumer spending I mentioned. I mentioned $1 trillion in consumer debt. Much of it is not by poor people. The default rate is very high too, very high. You know? And in case of a crash, it would surely be much higher yet. I think the default rate is right now 6% or so of consumer loans. And so this conspicuous consumption, if you just built $1 million home on a big mortgage, or bought $1 million yacht on a mortgage, no, that would be dangerous. Get your financial house in order for the storm to come. Oh, no, I'm not saying that this should be a disaster for you, surely not. Just get out of harm's way. Don't participate in this mania. And finally, another advice I would give is still something else, and this is, well, if you like finance, try to be in there and try to participate. Now, surely one could sell short or do something like this, you know. Remember, there are 3 types of income. Economists always talk about 3 types of income. There's labor income, professional income from the services you render. The labor income will continue, of course. The second type of income is interest, investment income, depending on the return, on the amount of savings capital you have. And the third type, which is always the only, practically the only source of family wealth, this is opportunity income. Economists call it entrepreneurial income. Seeing a change and adjusting to the change. That's practically the only source of family wealth, great family wealth. Someone in the family had saw something, saw an opportunity, and he had the courage to act, to pursue the opportunity. I think there are great changes to come. Changes in the financial structure. Can you imagine if suddenly this mania should come to an end? If suddenly, for instance, or it could also come from abroad. If suddenly the Japanese, for instance, would raise their interest rates from 0.5% or 1% back to 1, 2, 3%, then this carry trade of yen, the speculation with Japanese money converted into dollars and invested in American securities would immediately come to an end, which would be a very depressive factor in financial markets. But markets, this wealth effect, this conspicuous consumption, this massive consumption, the $1.2 trillion in consumer debt, what will happen to all this when the markets break? It's too ominous to reflect, to contemplate. Therefore, my advice is to get out of harm's way. No, I'm not saying that you should lose. No, this is no way to lose, to go from a market which pays 1.3% to General Motors or to a bond market that pays 7 or 8%. There's no sacrifice, but it's getting out of harm's way. And if you have the courage and the ability, although most of you shouldn't, because it really, to be an entrepreneur, to want to participate in all this, takes ability, time, strength, dedication, which you may not want to give to finance. May not be worth it. It's not your cup of tea. But you can get out of harm's way. Out of harm's way, that means out of this madhouse, which is the stock market. This is my advice. We don't know when this is going to happen, but we are fully convinced that sooner or later this is going to happen. As a matter of fact, after this last week, it's the last week, with the stock market charging through the Dow going to 7,500, 7,600, 7,700, just this last week. That's popular madness. No, I don't know whether there's going to be a break here. Surely there will be some minor breaks before the mania really will come to an end. There's another principle of mania economics, and this is normally in mania economics, the markets go back to the levels where they used to be at the beginning. That means, at the beginning the Dow was about 800, under 800 in 1982. Right now it's approaching 8,000. So some believe that it's inevitable that the markets will go back where they came from. I don't subscribe to that, but I do believe that the markets, like the Japanese markets, I think the Japanese market was 39,000 on the Nikkei. Now, and then right now, where is it right now? About 20,000. So cut in half. Cut in half 7 years later. I believe in that. That it will probably happen sooner or later that our markets will be cut in half. That's what we foresee. So my advice is get out of harm's way. Now, get your financial house in order. If you just bought $1 million yacht, $1 million jet plane, or $1 million home on a mortgage or loan, get rid of it. Live your lifestyle which you can afford and stay out of harm's way. That's my message to you today. Thank you very much. I'll be delighted to answer some questions. Yes, sir.
You wrong on a number of counts. First of all, you picked up 1982, which was a law. You should have picked up 1966. The market hit an intraday high of 1,000 in 1966. So from 1966 to today, it went up by a factor of 8. That's over 31 years. Granted, that's a big jump, but it's not quite as big in 1982, which was a low, to 1997, which may well be a high. Second, early in the 80s, we had defeated communism. A significant number of economists in Northern actually believe that socialism is a competitor to the free market economy, to capitalism. We have defeated socialism, we have defeated communism. We now know that the market economy works. We are investing in the market economy, and that alone is worth about 1,000 to 2,000 points in the market. Okay? Thirdly, there's the big investment 401k plans and the 403b plans. Those of you who are intellectuals here teaching in universities, pretty much everybody's investing in them now. I believe that inflow, there's a significant inflow from people who are saving in these plans. It's going to continue for another 5, maybe 10 years. Then the baby boomers are going to retire, and what you're saying is going to come to pass. But that's the nature of the beast. So we're betting, yes, the market is definitely going to fall eventually. When? Nobody knows.
Right.
It has often fallen a significant fraction, such as during the invasion of Cambodia, it fell about 30%. It's been unusually good, and I can agree with you that it's possible to fall, but also I think historically the market has been undervalued. If you look at real estate in the 80s, it went up by a factor of 4 or 5. Gold went up by a factor of 10. So now it's the time for the market. And that's it.
Well, thank you very much. I agree with some of this. You said I should have gone back to 1966, but I went back to the trade cycle, to the trough, the last trough, which was 1982. That was my point. The second point, that we defeated socialism and communism, surely is true too. In the past, there used to be heavy expenditures, armament expenditures at a higher rate than now, surely. And today, there's less of a defense burden than there used to be during the 1970s. 70s was the beginning of 70s, still was Vietnam. Truly, I agree. And as to the savings and into pension funds, surely it's all true. But you cannot deny that the present rate that's flowing into mutuals is tremendous. It's beyond savings. This is not just savings. I agree that these are funds seeking a tax shelter. But my point is that there's much beyond a regular rate of savings. So I still believe that I called it a mania, by the way, for the first time today. In the past, as economists talking to many audiences, I have talked about the bubble economy. In the program, your program is still listed a bubble economy. Today, for the first time, I have made it stronger. And I talked about a mania. I still believe, looking in the market last week, I still believe that this is a mania, not just a bubble.
Howard Phillips of the U.S. Taxpayers Party has said he has heard that if the euro does come into existence, that the central banks of Europe plan to dump the dollar as one of their reserve currencies and replace it with the euro, which of course would have catastrophic effects on the dollar, the stock market, and interest rates, and the price of imported oil, and other effects as well. Can you comment on that?
Yes, if the euro dollar, the European currency, comes into existence, but I bet you that it will not. Now, just in the last few weeks, with the French election, where the French support has weakened, in Germany is in turmoil about it, And so there's a big question whether the European currency will come into existence. Secondly, there's a big, even if it comes into existence, it may be a very weak currency, very inflationary currency, and therefore be no threat to the supremacy of the American dollar. So there are two ifs. If it comes into existence, I say if it comes into existence, and if it should be a strong currency, which I doubt, So relax about the euro. The European conditions are much worse, except for the mania, but they are following too. Their markets are following in our footsteps. But otherwise, their economists are in a worse shape than ours.
Dr. Sennholz, do you or any of your fine economist friends think that our financial institutions might not weather well the millennium bug, the year 2000 problem?
No, I don't think so. I think the institutions, even the mutuals, are rather safe. And even I could have talked about derivatives being used by the trillions. For instance, some of our banks have trillions in derivatives outstanding, like options and futures and swaps and so on. I could talk about it. But I think that's rather safe. And why? The mutual, what does the mutual owe you? If you make an investment in the mutual and the stock market crashes, the mutual only owes you the market value of the investment. There is no legal obligation to restore your deposit. It only has, the mutuals have the legal obligation to pay what the market value of the securities they manage, nothing else. Banks have the legal obligation to maintain your deposit, to pay back your money, but not the mutuals. Therefore, I don't think many mutuals will fail. You will lose people in the money, with the money in the mutuals will lose their shirts. Surely many mutuals will lose customers and then get so small that they no longer have an economic justification for existence and they will fold up, but not default. The mutuals will not default because there's no legal obligation to pay you in full. They only pay you what's left after the crash.
Your remarks about harking back to the 29 crash remind me of a relatively well-known remark that Joe Kennedy was asked how did he know that the stock market was going to crash and liquidated all his stocks before being very wealthy, of course, financing his sons later on. How did he know that? And his comment was that only a fool holds out for the last dollar.
It's true, but then the question is, what's the last dollar, It's true, that's right. Well, I don't think I'm giving radical advice here, do I? To take your money out of 1.3% return and put it there where you can earn 7 or 8%. And I do bet on General Motors surviving any crash, or take GE or whatever, some leading corporation, a bond, corporate bond. I would not buy government bonds. That's financing conspicuous, wasteful consumption by government. But surely the corporate bonds paying 8%. What's so bad about that? And then if interest rates decline, then they will even rise in price.
I listened very carefully to your comments about getting out of harm's way and moving into the entrepreneur area. I work 40 hours a week for Chrysler Corporation to pay my mortgage. I started several successful small businesses, and I help people accelerate their small businesses on themselves. In fact, it was my entrepreneur efforts that brought me in contact with DVP, and then I found myself becoming a volunteer on most efforts. My question is in regards to the entrepreneurial wave that's kind of going on. I've noticed that there is a great tendency for people to try to start small businesses with multi-level marketing and other service-related things where they are being a middleman or a salesperson, leading other customers to another service-oriented business, instead of starting a business where you are actually taking multiple pieces and putting them together and manufacturing something and creating something that has a higher value than some of those parts. Have you noticed, is there any observance of something like this going on as a regular trend or concern in our economy, and how it might affect small business and its nature?
Well, if there should be a readjustment, a recession, a decline, the end of the mania, it will have an impact on most economic services, most economic production, including medium and small enterprises. You know, surely. However, right now this conspicuous consumption is mostly in the wealthier classes of society. That's where the paper wealth has accumulated, and so any services to that class will probably get hurt badly, because once you have the dissipation, the disappearance of this paper wealth, then the $1 million mansions will be up for sale, and $1 million boats that are being built will be up for sale. The conspicuous consumption and all service industries catering to that conspicuous wealth will be hurting badly. So I would, if you advise entrepreneurial activity, I would rather than cater to the economy that's not bloated, where there is no bubble.
Yeah, there is a tremendous explosion of service-related businesses with the technology explosion we've
Yeah. Yes. Yes, sir.
Dr. Sennholz, we've had 2 days of discussion of all sorts of imminent disasters, the atomic war and biological war.
This is the worst one.
Economic war, yes, that's right. And it's something that...
This one really hurts.
Yes, unseen, but there. A lady asked her a question, and I don't think you understood her question. She was asking about the year 2000. This is something that surprised me that no one's discussed here, because it's an imminent disaster, as I see it, and there's a lot of people smarter than I am in the field of economics and computers see it, and no one's mentioned it.
Of course.
2000, the breakdown of the computer system, we don't have enough time to repair it, and it's going to be utter chaos in about a year, I think.
Of course, I've heard about this and I've read about it, but I don't quite believe it. Now, I am aware that nowadays the corporations are spending millions in order to prepare for this adjustment of the computers to the year 2000. As I know it, as I see it, right now, if nothing is being done, the computers as set up will read 2000 as 1900. So everything will be loused up, will be miscalculated, misstated, and so on. However, corporations are already spending millions to prepare for this, and this is 1997. I'm sure if there is a big technological problem, in my belief, it will be solved. I have this faith in engineers and computer programmers and wizards that they can solve this. I'm not convinced that that's going to be a disaster. It will cost some money to prepare our computers, but it will be done.
You're right.
That's my faith in engineering and in our scientists. One more gentleman, yes.
Would you comment on the monetization of the debt? Because they keep talking about M1, or the quantity of money in circulation relative to the hard assets in the society, in our society, and that if there's going to be a depression or a recession, that interest rates would go up to reflect, would have to go up to reflect the real cost of money and what people are entitled to a return to compensate for the inflation rate.
Most of the inflations we have known in the past are consumer price inflations as a result of the multiplication, the expansion of the stock of money. The printing of money by the Fed. That has been the inflation in the past. And there we talk, economists talk about M1, M2, M3. That means M is the stock of money in our pockets and our checkbook money. Altogether it's called M1. M2 is the same plus the savings our accounts. M3 is the same as M1 and M2 plus other liquid assets. Altogether some $4.5 trillion. When you look at, and I'm mindful, I'm watching this and I've written about, published about this. Our inflation today is different. M1 has not risen during the last year, even it has declined a little. M1. There has been no printing of money this last year. M2 has risen very little. And M3 perhaps has risen at a 7 or 8% rate. So the printing of money is minimal. In order to explain inflation in the stock market, you cannot look at the printing presses. You have to look at something else. You have to look at the fact, for instance, that there is a credit expansion in the sense, for instance, last year the banks issued 35 million credit cards. That's where the expansion of money, the credit cards, the banks, and so that's where there has been an expansion. And not just the banks, but also the non-banks. Non-banks, these are the financial institutions, the brokerage firms and others, where you can check against your stock market accounts. The mutuals, that's where the expansion of credit is taking place. Now, and moreover, as I mentioned, nowadays whatever money is expended, some goes abroad. And then it comes back, the foreign Asian central banks mop it up. They don't want to have the currency inflated. Then they turn around and buy US government security, send it back, and prop up the bond market again, and inflame the stock market again. That's the inflationary situation. Consumer prices, I mentioned, at a 2.3% rate right now, there's very little inflation. And the reason for it too is that the massive importation of foreign goods. About 25% of this new expansion of the economy comes from imported goods. The flow of massive amounts of consumer items keeping our prices down. Now, that's the present situation. It's not M1, not M2. You have a little expansion in M3, but it's not the printing of money. I rather will look at the millions and millions of credit cards and the use of credit cards. That's the expansion. That's where you have the expansion, not in the printing of money. Yes, sir.
Of course, we're on a totally fiat money system. I assume from what you're saying, you don't really feel that the commodities, gold, platinum, silver, are going to do anything. They're just going to sit where they are?
Well, yes. What has happened with gold. Every time gold wants to take off, then there's a foreign central bank which dumps another 100 tons of gold on the gold market. Now, last year, I think Belgium sold 200 tons, and then France and Italy are dumping their gold on the gold market in order to get their financial house the Europeans, in order to qualify for the euro, the European currency. There are certain conditions. Their budgetary deficits have to be 3% or less. And therefore, they can get their spending down. they're dumping, selling gold as revenue, and then say, look, our deficit is less than 3%. So, now, however, I'm mindful that gold and silver have been at a low level for a long time. Therefore, where there is uncertainty and panic, sooner or later there will be a run-up of gold. But I doubt that gold in the foreseeable future will run up from $345 an ounce, where it is today, back to $800 an ounce, where it used to be in 1980. Don't expect that. That was only a crisis, a monetary crisis of the world there. Under Jimmy Carter, there were $2 crises in 1978, number 1979. Dollar crisis when the world then tried to escape into gold and silver. Now gold at $800 an ounce and silver at $45 an ounce. So, but I wouldn't expect that. Nevertheless, in crisis, in uncertainty and fear and panic, surely gold should be an exception, should be a safe harbor for some wealth. Okay, thank you.